Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah. Over the next 30 minutes, we'll talk about a facet of mutual fund which is not quite here in the Indian markets as yet, but about to make its advent. And might be interesting to know about it. Bond funds. We haven't quite, bond ETFs, we haven't quite seen that when there. We'll probably see it happening very, very soon. Radhika Gupta, the CEO at Edelweiss Asset Management, joins us right now to talk about that, and she'll only tell us why is it that it is so important for them. Radhika, good having you. Thanks so much for joining in. Tell us a bit more about this, because it's, well, Greek and Latin for almost everybody in the Indian ecosystem.
Yeah. So it's interesting, you at your show and everybody else has been talking about passives and ETFs coming to India in a big way. But strangely, the assumption has been that ETF only includes equity and passive doesn't have everything to do with fixed income. When globally, bond ETFs or bond passives are a $1 trillion asset class, very, very relevant. And if you think of the Indian context, I actually think this whole discussion of passive funds is far more relevant for bonds than it is for equities. And let me tell you why. I think if you look at what a passive product brings to India, it brings essentially three things. One is liquidity. Liquidity has always been a problem in the bond market. It's something that people have talked about. It's very difficult for an individual investor to buy a bond today. I mean, if I wanted to go out and buy one of those good government bonds, it's very difficult to do that. Transparency is the other thing that ETFs bring because they are benchmarked to an index. For the last year, when we've been talking about the NBFC crisis, we've talked about the challenge in MF portfolio disclosures, knowing your portfolio once a month. Within ETF, you know your portfolio daily, and that's important to the bond market. And most importantly is cost. Bond mutual funds have a price, but cost matters more when returns are lower.
Yes.
In fixed income, your returns are 6, 7, 8%. So any cost saving really hits the bottom line faster than it does in equities. So that's why I think the bond ETF conversation is actually the most relevant conversation from a passive point of view.
Okay, so let's make it relevant. Tell us what is the nature of this product? What are the details that one should and would have in mind? Any timelines thereof, everything.
And I think this is the beginning of a bunch of conversations on this. But if you look at where bond ETFs started globally and what a bond ETF does, a bond ETF, just like an equity ETF, it's a mutual fund product that trades on an exchange. Just like an equity one, and I'm referring to equities because people understand equities to some extent, a bond ETF is benchmarked to an index of bonds. Now that index could be an index of government bonds, it could be an index of public sector bonds, it could be an index of 3 to 5 year bonds, it could be 5 to 7 year bonds, it could be 7 to 10 year bonds. But once that index and its rules are defined, then the ETF has to follow that in entirety. So there is no fund manager discretion or random credit popping up or random duration calls. You know what you're signing up for. That portfolio is, by the way, published daily on an exchange or third-party website, and your bond ETF mirrors that, which was my point about transparency. And the third thing with the bond ETF is it trades on an exchange. So you can buy and sell that bond ETF daily on an exchange. There are intermediaries called market makers who are there to facilitate the buying and selling. But unlike a fixed deposit or an FMP, for instance, where you put in money and it's locked in for 3 years, here money is available on call. So you have the features of liquidity and transparency.
I think a set of our viewers, might be wondering how is this different from the existing debt market products that are anyways there, because even right now when I put it into a bond fund, for example, through my agent, if I liquidate it, the money comes into my account the next day. If I yet again want to put it the very next day, I can still do that. So why is that this bond ETF is that much special a product?
So let me compare bond ETFs for you versus 2-3 traditional instruments that your viewers may look at. One is bond mutual funds. The second is fixed deposits, because they are our favorite instrument. And the third is buying bonds, because there are a lot of NCD issues and such kind of products out there. I think versus individual bonds, it is very difficult for your average viewer to go out and buy a bond. There's no transparent mechanism to go out and buy a bond. Often you need to put an amount of 10 lakhs odd as a minimum lot to even purchase a bond. The coupons from that bond, by the way, are fully taxable. versus an ETF carries the same debt mutual fund taxation. So that's the advantage versus individual bonds. Also remember, a bond ETF is a diversified portfolio versus a single bond where you are carrying single issue.
So no concentration risk.
So no concentration risk, liquidity, transparency. I think that's the difference versus a regular bond. Versus an FD, I think your big advantages are, an FD again is a single bank. An FD is locked in and there are lots of breakage and prepayment penalties. FDs for higher tax rate investors are fully taxable. Bond ETFs don't have those challenges. Versus bond mutual funds, I think your two big advantages. I agree, bond mutual funds you can redeem every day. Some of them have liquidity constraints. The two big advantages are, one, transparency. In a bond mutual fund, it is the fund manager's call as to what he wants to do. In a bond ETF, you know exactly what you're getting. So for instance, if you buy a dynamic bond fund, which is a common category of mutual funds, it could be holding a 5-year duration, a 3-year duration, a 1-year duration, basis the fund manager's call. It could be holding AA paper, AAA paper, some AA, some AAA. You don't know what you've signed up for. In this case, all the parameters are defined. A typical bond mutual fund also costs about 1% 50 bips to 1%. I can tell you a bond ETF is significantly cheaper than that.
Okay. So you almost making it sound, Radhika, that the advent of this, in a manner of speaking, puts out the death knell for people who understand all these products, puts out the death knell for maybe fixed deposits, maybe in some cases even bond funds, because this is a far superior product.
Look, it's, I have to say it's a product that we're super excited about. I must also tell you that, bond ETF understanding is fairly limited. There are multiple kinds of bond ETFs also that are out there in the market. If I could just go into this
Please
for a
do.
sec. There are broadly, globally, and over the last year, we've been studying this. There are broadly two kinds of bond ETF products that are out there in the global market. The space started evolving. If you look at global bond ETFs, they copied what global bond mutual funds were doing. So there's a concept called an all-term bond ETF, which is very similar to your bond fund. Typically, you'll have a 3 to 5 year duration, and the bond fund will, the bond ETF will hold bonds with a 3 to 5 year duration, a certain credit quality, etc. And as bonds mature, new bonds will keep getting added. So that's your all-term structure. Could be 3 to 5 years, could be 5 to 7 years, could be 7 to 10 years. There is a second and more interesting category that evolved in the global markets. BlackRock has a really interesting product called iBond, by the way. That's called a target maturity structure. And there the maturity of the bond is, or the bond ETF is defined. So you launch a 4-year target maturity structure in 2019, and it will hold bonds that mature in 2023.
Okay.
So if you hold that product for 4 years, it's actually very similar to a bond, and kind of, starting today, what you are likely to get. So bond ETFs also come in all types. There are bond ETFs that look more similar to a bond mutual fund, and then there are these bond ETFs that look far more similar to your FD or bond in characteristic. I actually think the second one is a very interesting structure for the Indian context and the Indian markets, because we essentially as bond investors, our understanding of duration, of credit is relatively limited. We seek predictability in our bonds. We invest in bonds for safety. And I think the structure gives you something of that sort.
The timing, if at all this comes about in the next 2, 3, 5, 6 months, is also interesting because it's it's coming subsequent to 12 or 15 months of not necessarily turmoil, but skepticism around the offerings from the mutual fund industry as far as the credit thing goes, right? Hitherto nobody thought that you will need advice for credit funds or debt-related funds. Now everybody thought that equity funds are okay. We probably need some advice for credit funds. And if this is transparent, liquid enough, and I would want your views there, if it's going to be liquid enough, this product, then it probably provides a real and definitive alternative to people who want to put money into fixed income as opposed to equities.
Yeah, I think you make a very relevant point. It comes at, whenever the offering is launched, it does come at a time where people ask a lot of questions about bond funds. In fact, I think when I meet advisors and investors, they're more scared by debt than equity, which is not a desirable place to be. And I often say that if you judge the bond MF industry by what happened in the last 1 year and run away from bond funds as a category, because they carry a huge tax advantage, Neeraj, then that is a big tragedy. And I hope something like that will be reversed with products like the ones coming up. So it comes at a very relevant time. There's an interesting statistic. Our FD market is more than 100 lakh crores, probably in excess of 150 lakh crores. I don't know if you know the HNI and retail participation in bond mutual funds. 90,000 crores for retail, 3 lakh crores for HNI. So it's a very, very small number. So it also comes at a time when, despite everything that has happened with mutual funds, SIP has become a movement, but bond investing has not become a movement, and it better, because 50, 60, 70% of your portfolio is going to be fixed income.
Yeah.
You can't mutual funds will not become mainstream until you win the fixed income battle.
What could be the potential concerns here? I'm sure that when you're talking about this, there are some global experiences which speak about there being one or two drawbacks or concerns, if at all. And because it's a new thing in India, everything that is new faces two issues. One is acceptance, two is liquidity.
Yeah. I think liquidity is going to be the primary question, to be honest.
Why so?
Because if you look at the past experience, so it is a known fact that equity ETFs haven't taken off in a big way in the retail population in the Indian context. Their AUM has largely been institutional. I believe equity is a very different argument from bonds, because I think in equity you have very comparable alternatives, and active funds have done well. So I don't think equity is a great proxy, but even there people have raised questions about liquidity, to be honest. I think that when we do put out the bond mutual fund product, liquidity will be our highest priority, and there are mechanisms globally. So if you look at globally how liquidity is created in ETFs, there is an institution called market makers that play a very important role in providing liquidity. They make sure that there is enough supply and demand of the product, so that if you as an investor want to sell the product on the exchange, someone can sell it to you at a reasonable price, at a not a material discount or premium. So that infrastructure is very, very important, and I think that's the most common question people will ask. Other than that, every bond ETF will come with its own characteristics, but as long as the portfolio is high quality, I think you've got a transparent, low-cost product in the offing.
But there wouldn't be a challenge for an individual retail investor to move in and out in the initial stages, or would there be?
I think if the AMC is able to take care of liquidity, then there should not be a challenge. And I think the real challenge for the AMC is to make sure that liquidity is adequate, so that if the yield of the bond is 7.5%, the spread up and down is not material.
Okay. Final question then, Radhika, on this topic at least. Who do you see this most suited for? Because a lot of times there are products that, for example, a lot of our viewers write to us about things that they want to, they've heard somewhere and they want to invest in, long short funds, etc. A lot of these are highly institutional specific products. So who do you think this bond ETFs would be the most suited for? What kind of investors? What category?
I hope that, the bond ETF, and of course we'll share more as the product structure comes out, but, we would hope that bond ETFs form part of the core medium-term bond allocation. So outside of your liquid and all that short-term stuff, this is not short-term in nature, but we would hope that this stuff forms a core part of your portfolio allocation, and bond ETFs are meant to take a simple asset class, which is fixed income, and simplify it further. So in that sense, they're suitable for basic investors. They're exactly the opposite of what you said in terms of long short funds, quant funds, and some of the more complex pieces out there. They're a simple product meant for simple investors who just want a basic return from their portfolio.
Well, as they say, inshallah, hopefully it gives them a much better and more simplified and a transparent product in a more liquid format as well. Radhika, I'm sure you guys will be at the forefront of it, so wish you all the best for this as and when it comes about. We look forward to hearing from the Edelweiss table about this.
Yes, absolutely. Look forward.
And to you and your team, a very happy new year.
And to you also. Thank you.
Thank you so much, Radhika. Pleasure having you, as always, on the show.
Thank you.
Well, so viewers, that's it for you. I reckon from whatever little I've heard from Radhika Gupta, as and when you hear about asset allocation within equities and then fixed income, maybe, just maybe, with the simplified nature of this product that is going to come about, it could form a core part of your asset allocation strategy, which could be a big thing for almost everybody. Now, the key question is, and something that we'll get an advisor's view on, is to whether investors will be able to accept it gleefully and in a simplified fashion or no, because it's something that is starting off, so not too many people know about it, and which is why it's important to get a perspective of somebody who's advising clients about such products. Tarun Birani, founder at TBNG Capital Advisors, joins us right now on the show. Tarun, good having you. Thanks so much for joining in. we were on the topic of a bond ETF, something that's not quite seen the light of the day thus far, likely to come in. What are your initial thoughts on the same?
Sure. So, Neeraj, if I look at the entire market size today, the fixed deposit market as we speak is a 40 lakh crore market. The mutual fund industry is a 25 lakh crore market, and out of that 10 to 11 lakh crores is a debt category as we speak. So it's a very big category, and I think capital protection as well as stability is one of the biggest feature which a debt product gives. And I see a very big potential for this category in future also, because as advisor I see the protection and the stability part is something which debt is the only product which can get us there. So there is a lot of potential for products like these, like what we are talking about, debt ETF, but we need to see how things are going to pan out, because ETF as an equity, if I talk about the experience of equity ETFs in India, it has not been that great. If I look at it has been challenging for the simple reason, maybe it is driven out of equity market, and equity market has its own share of ups and downs. But if I look at from 3-4 different angles, one is from a cost perspective, ETF looks as a very cheap option. From a liquidity point of view, I think it's a extremely challenging thing today for anybody investing in a single bond, and getting a liquidity out of it is a challenge today, which if this bond ETF structure able to, and globally I think it has been a successful model, and that is the biggest gap this bond ETF is going to help us. And transparency, I'm sure with bond ETF, with day-to-day NAV calculation, day-to-day transparency and liquidity thing, I think the transparency will be much higher compared to the debt mutual funds what we have today.
What could be the challenges here? Radhika Gupta was saying that for anybody who wants maybe better than FD returns or otherwise as an alternative to fixed deposits, even for a retail investor, a bond ETF might be a good option, simply because one, it will be diversified in nature and not concentrated, and two, as and when the market develops, it might become a bit more liquid as well. What are your thoughts on the same?
I think it is, Neeraj, according to me, it is too early to comment on that part. I want to see the finer details of the product, let it come out in the market. Then we can talk more in detail about it, because this is an evolving product and category which is developing in the market. So I'm not sure how it's going to take shape. But looking at if, let's say, sovereign or government-oriented bonds form part of these ETFs, I think it can really help us in creating a lot of trust we can build up on these kind of products.
Let me rephrase my question then, Tarun. Based on whatever little knowledge you have about this, and of course the vast knowledge that you have about the other fixed income products available, who would need to go and invest in a bond ETF? Are there any particular kind of investors who are currently investing in any kind of fixed income categories wherein the bond ETF, if it is liquid enough, might give a better bang for the buck?
So my experience with the debt mutual fund, and I think debt ETF, bond ETF versus debt mutual fund, this is a closer competition I would talk about. I have seen more sophisticated and more HNI oriented client, or the institutional clients are the ones who are investing more in the debt category. I have not seen that kind of retail participation coming in the debt mutual fund. So, and again, debt ETF has a problem. You need to have a broking account or a demat account, which again could be a problem wherein a retail investor cannot get in there, and it is too complicated to put a trade for it and buy sell kind of orders. So I find it very challenging in terms of debt ETF taking off smoothly in the market. So these are some challenges I can see how they are able to solve it. Like in gold ETF, they have been able to solve it by making a gold mutual fund, which in turn by ETF.
But we already have bond funds. My question is, so the execution challenges are one thing. Would the returns be far more superior? Because eventually, if the returns are there and superior over a 5-year, 10-year period, then people might even take the pain of doing all that you're saying. would the possibility of returns be superior compared to the existing fixed income categories?
No, I don't think so. I don't think so. Return will be much more superior because end of the day, you have all these government bonds available today also. End of the day, underlying is all these government securities only. So the returns, I don't see that it's going to be superior. I think liquidity is one very big challenge which they try to help.
Which Radhika also mentioned, by the way, that it might be a problem.
But return point of view, I don't see that because taxation, everything is similar. So I don't see anywhere else post-tax returns will be much higher.
Okay, so a product coming for sure, and maybe a lot more diversified in nature. Liquidity might be an issue, and Radhika Gupta optimistic about it. Tarun Birani believes let it come, and then we'll try and figure out more about it. But the initial stages, maybe, just maybe, for people who have a demat account, might be a good one. For others, I think time will tell. So, but keep in mind, it's something that's coming up soon, and you need to know about it. And that is why we're doing this show, specifically talk about, first off, the debt ETFs. Now, Tarun, I also want to just move angles a little bit and talk about gold, simply because of the kind of interest that gold has generated. The last couple of months, there has been significant inflow in gold-linked ETFs, funds, what have you. Now, can you talk a bit about this, whether or not it's a good idea to make an investment here, and between the two, between a gold ETF versus a gold fund, what would you choose and why?
Right. So we Indians love gold, and I think the numbers I was reading today, Indian gold market is approximately 75 lakh crores is the gold market. Real estate is 80 lakh crores. Mutual fund is 25 lakh crores. Fixed deposit is 40 lakh crores. So you can see gold is one of the biggest asset class, and we Indians love physical assets. We love gold. Talking about, I feel gold is not an asset for wealth creation. Gold, in turn, if you look at any asset which can help you create wealth, need to have a capital appreciation. Gold doesn't have a capital appreciation. It only works because of greed and fear. If you see the underlying,
it's not an asset which is generating.
Yeah, no interest or dividend comes out of it.
Sure.
Yeah. So this is a challenge of gold per se, and due to that,
fundamentally.
But
history shows that there is capital appreciation.
But if you look at last 30-40 year returns, the returns have been between 8 to 9% CAGR returns. So they are inflation linked returns. So it's not a wealth creation asset. So this is one myth one need to break in, that gold cannot give you double the inflation kind of returns.
Yeah, sure.
Right? But you end up taking a lot of risk in gold also, because the price is volatile also, right? But so I always tell my clients that gold should be a part of your portfolio for your social requirement, not for a wealth creation objective. It should not be more than 10-15% of your overall net worth. That is one cardinal rule which we follow at our clientele. Talking about the second thing, the vehicles, how can we invest in gold? So there are gold ETFs available, and there is a recently, couple of years before, sovereign gold fund has come into market. I will try to compare both these products with 5 different parameters. Talking about first parameter is in terms of transaction charges. So the sovereign gold fund is the cheapest available. There is no expense in that product, whereas ETF will always have an expense.
Yeah.
Talking about liquidity point of view, sovereign gold fund is an 8-year product, and after 5th year only liquidity comes in. So there is no liquidity in that. In terms of ETF, you always have a liquidity available. In terms of interest, and I think that is one very interesting feature, 2.5% interest what this sovereign gold bond generates compared to a ETF. In terms of taxability, again there is a catch there, that sovereign gold fund, if you hold it till a maturity for 8 years, it's a complete tax-free product for you. In case of ETF, you end up paying the debt taxation, more than 3-year indexation benefit. I think one very superior feature about gold ETF is the regular investment, and I think that's where anyone can do a monthly investment planning and all those in a gold ETF, compared to sovereign gold fund, which there is no timeline available for that. So these are 5 different features. If you are looking at a lump sum investment, one-time investment, sovereign gold fund is a wonderful vehicle. In terms of regular investment, gold ETF is the another vehicle.
Yeah, just some small clarity, and correct me if I'm wrong, Tarun, but I think Tarun is comparing the sovereign gold bonds which are available and which yield that interest of 2.5%, if I'm not wrong, versus a gold ETF currently. The other comparison, Tarun, and I think a lot of people tend to do that because people don't still know the differences between a gold fund and a gold ETF. And just wondering if you believe that a gold ETF might be a better bet than a gold fund, simply because I presume that gold funds would eventually go out and invest their monies into various gold-linked ETFs, and therefore the expense ratios could be higher.
No,
maybe.
So here what I have just compared is a sovereign gold fund.
Right.
This is issued by RBI,
yeah.
Government of India guarantee kind of product. So that's a different product.
That's a product.
We are talking about gold mutual fund versus a gold ETF.
What would you do
gold
there?
mutual fund in turn invest in gold ETF.
Right.
Yeah.
And between the two, would you prefer that clients should go in for, viewers can go in for a gold ETF compared to a gold fund?
Again, it depends on the sophistication level. So
Okay.
gold mutual fund is good for somebody, let's say like a normal mutual fund, they can do a SIP very easily.
Okay.
In terms of gold ETF, you need to have a broking account, demat account, you need to punch in the order, which I think a normal investor will not have that kind of sophistication available.
Okay.
So based on your convenience and understanding, one can look at it.
Okay, fair call.
Yeah.
Tarun, one last question. Any last pieces of advice? There's a clutch of things that have happened in the last few days and weeks. Some AMCs have seen CIO changes. There has been some significant market rally as well, and people whose SIPs were on have seen those SIPs gain some ground as well. We're just shifting tracks for one last time. Would you believe that at this cusp of markets, people should book some profits out of their mutual fund investments, or would it pay to stay invested simply because the markets look like picking up?
Yeah. So Neeraj, I'll continue with my boring advice all the time, which I keep giving. I think asset allocation is the most important thing. Focus on your purpose and goal. And I think all these noises will always be there. Every 6 months, 3 months, there is something or the other news keep coming in. I think focus on your asset allocation and objective part. If your objective and goal is very clear, and if you have a longer horizon, I think suitability exercise can help you understand how much and where to invest.
Sure.
And keep that kind of horizon, keep rebalancing, keep reviewing. And I think that's the mantra. No need to get too much into all these things.
Okay. Well, sound advice, and Tarun saying it as he thinks it to be right. So on debt ETFs, not completely bullish. Between gold ETFs and gold fund, suitability will matter. Maybe going for the sovereign gold bonds if indeed that is something that works for you. Tarun, thanks so much for taking the time out and joining us. Appreciate, and to you and your team, a very happy new year.
Thank you so much. Same to you.
And viewers, thanks for tuning in to this first episode of the Mutual Fund Show in the new Samvat. Stay tuned to BloombergQuint.